Hi, I'm Jenny Brown. Welcome to this week's MFB News. I hope you're all keeping really well. It's hard to feel particularly upbeat at the moment, isn't it, with so much bad news around, but let's see what we can do this week to try and turn that around for you, because actually in amongst all the kind of more negative news that we're hearing, there are some glimmers of light as well. So let's try and turn the upbeatness up a little bit this week. So what have we got for you? So we're going to be talking about interest rates, obviously a huge amount of focus on that at the moment. I'm also going to be sharing with you some insights into what we're seeing our clients doing. Actually at Mortgages for Business, we're incredibly privileged to work with many landlords. We have thousands of clients, and actually these guys are they're very professional, they're very good at what they do, and also they're incredibly agile. So these guys know how to react when the market throws a bit of a curveball at them. So I'm going to share with you some thoughts into what we're seeing our clients doing at the moment, which may just get you kind of noodling on some possible ideas. I'm going to share with you the latest outcome of the Mortgage Works buy-to-let Barometer, which is where they've been out and surveyed landlords and really got their kind of view on how they're seeing the market, how they're feeling about things, what their plans are. I always think it's interesting just to hear how peers are feeling and what their plans are. And then lastly, Home Track have released their latest report with regards to house prices and rolled out some predictions there in terms of what they think is going to happen over the coming few years. Okay, so today is Friday, and yesterday the Bank of England met up and agreed to increase base rate by a further 0.755%, bringing Bank of England base rate to now 3%. Now, the reason they've done this is that inflation is still running incredibly high, currently at 10.1%, and they simply have to bring this down. And one of the greatest tools they have at their disposal to help do this is the Bank of England base rate, essentially. So by increasing interest rates, the hope is that people will be more cautious with their money, stop spending so much. That will drive down the cost of things and therefore curb inflation. In terms of where this is going to go, so I think at the moment, I think people are feeling slightly more kind of confident in terms of the trajectory of travel, in terms of the plans that are being put in place. More will come out in the autumn statement in a couple of weeks' time. But I feel that actually people are sort of thinking that actually we're dealing with this now, we're being much more fiscally responsible. So this whole kind of, we're just going to throw loads of money at things and we're going to grow, that didn't go down well at all. The people didn't really buy into that concept. Now we're talking about more taxes, spending cuts, this kind of stuff, and actually the markets are responding much better to this. So actually the expectation now across the market, it does depend who you're talking to, but I think the general consensus is that base rate's going to end up at between 4 and 4.5%. There are some people who are saying 5. We're not convinced on that. We think 4 to 4.5%, which does mean there are further base rate increases on the way, but actually we're hoping that we won't see another increase until into the new year now. So there is a base rate meeting in December, but we're hoping that actually, because this will be in the wake of the autumn statement, actually we should have a bit of a breathing period now of no more interest rate or base rate increases. Now, in terms of what this means for mortgage borrowers, so actually if you're on a fixed rate mortgage, this is really going to have not a huge amount of impact for you, at least for now. For those people who are on mortgage rates which are linked to base rate, I'm afraid your mortgage rate is going to go up by exactly 0.75%. For those people whose mortgages are linked to a lender's standard variable rate, which is not directly linked to Bank of England base rate, I suspect you will see an increase in your mortgage interest rate. It won't necessarily be by 0.75%. The two are not inextricably linked. If so, you might find that yours goes up by 0.25%. You could find out it will actually unfortunately go up by 1%. There's no direct correlation per se, but actually generally speaking, if base rate goes up, all variable rate mortgages do tend to move up at the same time. So that's your variable rates at the moment. Now, we've seen swap rates easing back down since the mini budget when they spiked at 5.2%. Swap rates are essentially fixed rates. So we've seen 5-year swap rates now hovering at around 4.1%. That's kind of where they've been sitting for the last few days. And we are expecting these to start easing down further, and particularly so once we get closer to the autumn statement, where the government's going to be setting out its plans for its fiscal kind of responsibility, what it's going to be doing to get the UK into a much stronger financial position. So I do think that actually swap rates are going to start easing down. When are we going to start feeling this in terms of actual mortgage rates? So actually what's been interesting is there has been some press around lenders, bringing down their fixed rates. I have to be honest, we're not really seeing a huge amount of that at the moment. We have seen a couple of reductions. We've also seen a couple of increases as well. And I think I talked about this last week, lenders are really just kind of sitting back at the moment, letting the dust settle, letting things really, really calm, waiting to see what happens. Because when lenders are lending to you on a fixed rate mortgage, they are essentially saying, well, okay, our cost of funds, our swap rate is 4.1%. We need to make a margin of between 2 and 2.5%. So arguably at the moment, we need to price it between 6.1 and 6.6%. Now, one could argue that actually lenders could bring their rates down a bit, but then if we had the autumn statement and there was some massive clangor in there, which sent the markets absolutely nuts and up through the roof again, as per mini budget horror, then the lenders would be back in the same position we were a few weeks ago. And no one wants to repeat that. That was not good for anybody when the lenders all kind of stepped away from the market and it all went into meltdown. So really what's going on at the moment is the lenders are saying, look, the market's feeling much more comfortable, we're feeling much more secure, pricing is settling down nicely, let's just give it a couple of weeks to see what happens. So the upshot of this is I think that we are going to see fixed rates start to come down. You will start seeing it over the next couple of weeks, but I think actually the really big impact is going to be once we've got the autumn statement out of the way. So realistically, probably start of December time, but you might see some coming through a little bit earlier. Now, in terms of where we are on pricing, so 2-year fixed rates for individuals. So let's just say this is for individual mortgages, so people who are owning property personally on standard properties, so no HMOs, no multi-units. So 2-year fixed rates from 5%, 5-year fixed from 5.1. There is no change on the last couple of weeks, actually. This is just where they've been. The lowest variable rate now is at 3.64. The lowest still with no early repayment charges is 3.99. So same thing for limited companies. 2-year fixed rates 5.69 for a 2-year fix. 5-year fixed from 6.04. Variable rates from 3.99, and actually variable with no ERCs also from 3.99. Now this really sort of dovetails very nicely into what we're seeing at the moment. So we've got a large number of borrowers who are saying, do you know what, I'm quite comfortable to take a chance on a variable rate. So actually I could fix, on a limited company 5-year fix at 6.04, or I can take a variable with no ERCs at 3.99, so essentially 4%. Actually I'm willing to gamble that I don't think interest rates are going to go up that quickly. And actually, if we look at what we were expecting fixed rates to do, based on what I was just saying about swap rates, we're expecting them to come down. So some people are saying, I'm going to go on to a variable rate with no early repayment charges for now, because I think in the short term that's going to benefit me. But I do know that also, as fixed rates start to come down, I can then simply jump off of my variable rate and onto a fixed rate at the point when they kind of cross over, and they will cross over it going forwards. So that's a really neat idea. Now, in terms of other sort of opportunities, so one of the things we're very, very focused on here, and I'm really glad that clients are also asking the same question, is if I apply for a mortgage now on a fixed rate and before completion, the lender brings down their mortgage rates, their pricing, will they let me switch onto one of their lower interest rates? Now, some lenders do allow this, some don't allow it, and some allow you to do it, but they're going to charge you a small fee for doing so. So what we're saying to our clients is, look, if you want to actually take a fixed rate right now because you just want to know that you've got something and you are, the whole kind of unsettled sense of everything at the moment is really kind of just making you feel very uneasy, so you'd like to lock in something, either way, then actually if you make sure that you're applying to a lender who will allow you to switch on to a lower rate if it becomes available before you complete. Once you've completed on the mortgage, you're stuck, right? There's nothing you can do about that. But in the run-up to completion, you can switch. Some borrowers are actually saying, do you know what, I feel that this is really kind of having my cake and eating it. So that's definitely a focus of our clients at the moment. Now, the other thing that we're seeing a definite upswing on in terms of inquiry levels is HMOs. So always, when landlords are feeling their cash flows are being constricted, and by this we're talking about by higher mortgage costs, landlords always start to really rethink their investment strategy and how they can generate more cash flow. And HMOs are always the way that people go with this. So I think it's really worth, for those people who are thinking about investing going forwards, who haven't maybe thought about HMOs before, it is definitely worth considering. Now, in my experience, some people will say, oh, I don't really want to let a property to students. I'm not sure they look after the properties very well. And there's a whole kind of stigma attached to HMOs. For those landlords who are in the HMO game at the moment, these guys will be laughing away listening to me saying this, because they know that actually these days that really isn't the way of the world. So student HMOs, but also professional sharer HMOs, these days actually are tend to be very high quality stock let to people on a very professional basis, and they're well looked after. I mean, in any property, right, you can get a road tenant who doesn't look after it, and that's part of the game, isn't it? But actually, just generally speaking, just because it's an HMO doesn't mean your property is going to be getting trashed every 5 minutes. And actually, you know, the kind of things that people are looking for when you look at HMO research at the moment, the highest priorities for prospective tenants are things like the quality of the broadband, is there a sort of shared working space, ensuite bathrooms. These are people who are actually looking for lower cost accommodation, but professionals nonetheless. So I do think it is really something worth looking into. Now, one of the things we found with HMOs in the past is that a lot of lenders do say, look, we're not willing to lend to someone on an HMO mortgage unless they've got experience of renting property previously. And the reason for that is that if you've never let a property in your life, but then you buy an HMO, so you go from having no tenant experience to suddenly having 5, 6, 10 tenants all at once, that can be a real baptism of fire, possibly too much for one person to take on from the beginning. Also with HMOs, there can be some slightly more complex licensing rules around room sizes, you know, fire safety regulations, that kind of stuff. So also they're a little bit more complex in terms of the rules and legislation that sits around them. So to this end, a lot of lenders have just said, look, we just think these are more appropriate for those more seasoned landlords. Having said that, there are also a handful of lenders who will do HMOs for inexperienced investors, so first-time landlords. So actually, if you have thought about doing this in the past, you're not an experienced landlord, and so this kind of sense of I can't get a mortgage because I don't have the experience has put you off, actually that isn't the case. You can get a mortgage on an HMO. So just a couple of ideas about what your peers are up to at the moment in terms of how they're looking to kind of buck the trends of the market and maybe sort of make good of a slightly difficult situation. Okay, now the Mortgage Works have released their latest buy-to-let barometer for the previous quarter. So this is essentially for quarter 2 of 2022. Now what they have reported is some findings in terms of landlords' plans. So currently, of the respondents to their survey, of which there were sort of many hundreds, 12% of respondents are planning to buy a property in the next 12 months. And that is down 2%. So in the previous quarter, it would have been 14%. So less landlords now are planning on increasing their portfolio than there were in the previous quarter. Conversely, 28% of landlords are likely to sell a property in the next 12 months, which is an increase of 5%. So 5% more landlords are thinking about selling a property in the next 12 months than they were in the previous quarter. Kind of rolled in with all of this, landlords' optimism for the short-term prospects of their own letting business drops to its lowest level since the COVID-19 pandemic, with just 27% of landlords feeling positive. Now, it's interesting in terms of what's driving this. So actually, if I go on to give you the tenant demand numbers in a second, I must say I don't entirely get why landlords are feeling so negative. I can only deduce that it's to do with increased borrowing costs and legislation, because actually 65% of landlords are saying that tenant demand has risen in the last 3 months, 39% saying it's risen significantly, 39% saying it's increased, 26% say it's increased slightly. So landlords are actually seeing more increased demand from tenants. We know that rents are going up. We know how property prices have gone up really significantly over the last few years, experienced a small dip in 2023 and expected to stay flat. So I can only assume that landlords are feeling much more bruised in terms of the legislations, the white paper levelling up, so Section 21 abolishment, MEES, landlords registers, smart homes, all that kind of stuff which sits very much at the centre of landlords' kind of minds actually at the moment, and also the potential about paying more on their mortgages. But really, really sad actually to see that landlords are feeling not as kind of optimistic. What I would say conversely to that is that actually if the 28% of landlords are going to sell a property in the next 12 months, that means there's going to be less buy-to-let properties available on the market. And this is on the horizon of an increase in tenant demand because less people are going to be able to buy properties in the next year or so because of the increased mortgage costs. So what that does mean is that actually there is going to be less properties on the market to rent with a greater demand of people wanting to rent them, which means actually void periods will be lower, rents will definitely hold up and actually increase over the coming few months, which actually to my mind as a landlord is a positive. So I think for those people who do decide to stay in the market, and I think most of you probably will, actually I think the future has some real positives to it as well. Okay, now HomeTrack have released a report. I really like HomeTrack actually. I find the way that they produce data really, really good, very, very accessible, and also it always feels incredibly balanced in terms of the reporting that they do. And you can sign up to their reports for free, incidentally. So by all means go off and get your own copy. But look, these are the kind of key highlights that I've taken from their report they've just released. So essentially what they're saying is that demand for housing transactions, house purchases has definitely slowed down since the spike in mortgage costs after the mini budget. However, having said that, there is actually no signs of any impact on property pricing in Q4 of this year. So actually things are expected to stay the same. Now what they're saying is that the outlook for 2023 largely depends on the trajectory for mortgage rates. So a sustained 6% mortgage rate would lead to double-digit price falls, eroding paper gains over the pandemic, but few negative equity cases. So what they're saying is that if mortgage interest rates hit 6% and stay there, this would mean that actually we would expect house prices to reduce by over 10%. However, all this will be simply doing is eroding the paper gain that property prices made on value during the last couple of years. And I'll go on to that in a bit more detail in a moment. What they've then gone to say is the more likely outcome is a fall in mortgage rates towards 4% and a modest decline in house prices of up to 5% over 2023, with 1 million sales going through. So actually their kind of view is that house prices are more likely to kind of fall by around 5% next year, not the larger figures that you may have seen reported in the press over the last week or so. They do go on to say that the robust labour market and scarcity of supply will support pricing, but markets in southern England are likely to feel the greatest impact. Now, going back to this kind of paper gain that I mentioned a moment ago, so essentially what they're saying is that house prices have grown in value hugely over the last 12 months. So as an example, the largest sort of gain was for Nottingham at 10.9% growth, Manchester was at 9.3%, Birmingham was at 9.2%. Conversely, Edinburgh and Glasgow had the lowest growth rates of 4.2 and 4.6 respectively. But in the round, the UK has seen the average UK house prices increase by over 8%. So if we saw house prices drop by, say, 5%, that's 5% against a growth of 8%. So actually still, ultimately, you haven't really lost anything. The only people who I guess are going to come unstuck are those people who have acquired property in the last 12 months. But I thought it was really interesting just to read a kind of different view. I know that Lloyd's recently produced their predictions on house prices, and they were very, very damning. So it's interesting to see different kind of perspectives on the expectations for the property market. And that's me for this week. I'm genuinely hoping I'll be back next week with you, telling you about some new lower fixed rates. I do really feel we're on the cusp of this now. When I talk about lower fixed rates, incidentally, what I'm not expecting is to be saying that there's a rate starting with a 2%. What I'm really hoping for is for very, very vanilla deals, low fives, for limited companies, HMOs, multi-units, those kind of more specialist rates, high fives, low sixes, I think is where we're going to be, at least until the end of this year. But actually a reduction of any description is a really positive thing. As always, if you have any questions, do give us a call 0345 345 6788 or have a look at our website mortgagesforbusiness.co.uk. Have a really wonderful fireworks night. Look after yourselves, and I will see you same time next week.